Hello, listeners, and welcome to our latest European Structured Finance webinar. My name is Mudasar Chaudhry, and I head up the European Structured Finance research efforts. And today I'm also joined by Christian Offsets, who is the head of the European Structured Finance team, and both of us working out of DBRS Morningstar's London office. Here's a quick overview of today's webinar. So Christian and I will be providing you an update on the European securitization issuance, developments on the ESG front in the European structured finance, recent macroeconomic headwinds combined with monetary policy tightening and their impact on the structured finance market. And with this backdrop, our credit and issuance outlook for the remainder of the year. We are going to divide our time in a presentation form, which will be followed by a Q&A session. Questions need to be asked in writing by typing into your BrightTalk portal. So we will answer these questions at the end of the presentation, but you can ask questions at any time during this webinar, and we encourage you to do so. So without further ado, let's move to our presentation. Looking at the securitization issuance at a high level, unlike the beginning of the first quarter of 2022, the European securitization transaction issuance did not start this year in a very strong form because of higher inflation, geopolitical tensions, and global economic events that caused much uncertainty in the credit markets. Overall, issuance decreased by about 44% when compared with the last quarter of 2022. And issuance was roughly down by same percentage when compared with the first quarter of 2022. So the quarter one finished with a total issuance of 37.6 billion euros, out of which roughly 58% was investor placed. That represents a decrease of about 44% from last quarter of 2022. Due to tightening of asset purchase programs by central banks, retained issuance has decreased, which in turn is making the investor-placed issuance look as one of the best quarters in the last 3 years. In January 2023, we published our credit and issuance outlook, and after the end of the first quarter, our forecast in terms of issuance remains unchanged for the full year, where we expect total European securitization issuance to be between 185 to 195 billion euros, with distributed issuance to be about 48%, compared to last year's total issuance of roughly around 210 billion euros, which was split about 39% with investor-placed transactions. Now, the question may be, why are we expecting higher distributed issuance for 2023? Well, for exactly the same reason what we have observed in quarter one of this year, the way ECB's asset purchase programs, and in UK, a similar program, which is the Term Funding Scheme, or TFSME, are either ending or slowing in their purchases. And this could act as an impetus for issuers to come out with investor-placed transactions to keep the flow and access to funding. With that, Christian, could you please take us through the breakdown of quarter one issuance this year?
Surely, Mudasar, many thanks. Maybe, it's always worth starting with distributed issuance because it presents the real European securitization market, i.e. what is placed with investors. And what Mudasar had alluded to, on the distributed side, the first quarter of this year actually didn't look that bad. The big decline of total issuance was more pronounced on the retained side. So, but still, the quarter was characterized first by a moderate recovery on the credit markets, and then at the later part or later weeks of the quarter, banking troubles across the pond, meaning it was overall still reasonably risk-averse quarter. So that means that by sector distribution in terms of distributed issuance, we see that the biggest contributor, which is a higher beta asset class leveraged loan CLOs, declined compared with the first quarter of last year, whereas the commoditized plain vanilla asset classes, meaning prime RMBS and auto ABS, actually show year-on-year growth compared with the last 2 years, where we actually have seen the biggest decline in placed issuance is the buy-to-let RMBS, which, if you look at the decline in that subsector, generally contributes to the entire decline of distributed issuance. So why is this? I think to one extent the risk-averse environment, but also that the first quarter of last year saw some very large buy-to-let deals, which were simply not repeated this year. So, but outstanding is certainly the increase in auto ABS, which together with the prime RMBS market drove the recovery at the beginning of January, at the beginning of the year, but then also more recently restarted the market after the troubles on the banking side. Last quarter, which is unusual for the first quarter of the year, we also saw a non-performing loan transaction which was placed in the market, but notably absent was the CMBS market. Now, looking at sector distribution, a little bit different, one focusing on total issuance and looking at it percentage-wise. Usually in European securitization, RMBS dominates total issuance. That is true for this year so far as well, but less than in previous years. And this is partly due to that in the past, a lot of RMBS transactions were retained. And given the decline in retained issuance focused on the RMBS side, the overall domination of the sector declined. You see here an interesting feature that UK non-conforming RMBS or non-conforming RMBS, including UK, actually increased quite substantially in terms of total issuance percentage, although distributed issuance did actually not increase much. That is due to something we have seen at the beginning of the year, where given the spread environment, big senior tranches in the non-conforming RMBS sector were actually retained and only the mezzanine and the junior classes placed, meaning that in an unusual fashion, non-conforming RMBS actually contributes to retained issuance, which if you look at it from purely retained side, one topic of the year, given less central bank support, as Mudasar mentioned, there was certainly the expectation that retained issuance for central bank purposes will go down, what we saw also in Q1. But if you add to that part of the existing retained issuance actually part of a placed transaction, the central bank induced decline is actually more pronounced than the numbers would suggest. And again, sector distribution by percentage does not show any CMBS. NPL is very, very small, but that's usually to be expected for the first quarter, given that the Italian non-performing loan issuance is usually very backloaded in the year. Aggregating that all by the bigger sectors, so it's basically repeating of what the previous slide showed. RMBS contribution to total issuance decreased quite substantially, driven by less distributed buy-to-let issuance, but also less prime issuance, retained prime issuance, whereas auto ABS increased quite substantially its issuance contribution, given that this is one of the sectors which usually restart the markets after time of volatility. Lastly, last quarter by country. Here, not many surprises. So as usual, pan-European deals and the UK are dominating. Pan-European is the leveraged loan CLO market, and the UK is mostly or to a very large part the UK RMBS market, where at the beginning of the year we saw some prime issuers come back. Germany stands out with the quite big issuance last quarter due to two effects. One is the dominance in auto ABS, which was strong on the distributed side, but we've also seen a large German retained RMBS. And then what you can see in the country distribution is that let's call it higher beta countries or more peripheral countries in Europe, they wouldn't see much issuance out of these countries on the distributed side when the markets are volatile. Hence, issuance indeed dropped in the first quarter in Spain and Ireland if you compare it to the last quarter. So maybe quickly on issuance outlook, Mudasar already mentioned. We have already seen since Easter that there has been a recovery, many deals announced and successfully placed in the market. And we expect that to continue or even pick up once the central bank hiking cycle is over. So we expect in terms of the sector issuance contribution, as usual, that there is a gradual migration after about the volatility from the more prime collateral, the phase we are currently in, towards the more credit incentive asset classes once confidence returns to the market. And then the CMBS sector will be the last to reopen, which is usual. Non-performing loan sector, we expect the sporadic placed issuance to continue, as we have seen in first quarter of this year with the Cypriot transaction. But the total issuance obviously heavily depends on the extension of the Greek and Italian government schemes, HAPS and GACS, where an extension is becoming more and more unlikely. And on the retained side, Mudasar mentioned our outlook remained unchanged. We would expect that year on year to increase, given less need for central bank funding or central bank funding schemes being expired. So with that, I quickly hand over back to Mudasar.
Thank you, Christian. And now let's look at an increasingly relevant topic of ESG. ESG considerations continue to gain traction, and issuance of sustainability or ESG bonds has been increasing in the past few years. There is a strong demand and intent on part of the market participant to increasingly turn towards ESG-related transactions in the capital markets. Total European ESG and sustainability-related bond issuance volumes stood at 405 billion in 2021, a record year at that time. And the volumes dropped to 354 billion in last year, thanks to the macroeconomic and geopolitical issues. But in the first quarter or year to date in 2023, the total ESG and sustainability-linked issuance stands at 117 billion euros, out of which 80 billion is green bond issuance, which represents an increase of around 71% on year-on-year basis. Nonetheless, the still globally the total bond issuance, green bond issuance, only makes about 1% of the total volume. So still early days for this trend to continue to increase. The issuance figures shown here also include the issuance from sovereigns, agencies, financial institutions, so includes the issuance of cover bonds, corporate debt, as well as the securitization issuance. So Christian, specifically looking into the world of securitization, how does the ESG label issuance look?
Yeah, from the European securitization side, the market of green and social bonds, certainly compared with other sectors of the fixed income market in infancy. But it had been picking up back in 2021, which you can see on the left-hand slide. And I remember that time we were all amazed by how quickly the number of green and social bonds in the European securitization market increased. With hindsight now, 2.5 years later, one asks themselves the question, was that the outlier? But in short, we don't think so. We expect that the instances of green or social bonds to increase gradually over the years. And looking back into 2022, which was not a very vibrant European securitization issuance environment, in order for green social bonds to be issued, they need to be bonds issued. So, and we would expect that with the market recovery, that also the instances of green or social bonds in the securitization market will increase. And indeed, what we have seen in the first quarter of this year, there were already 2 green bonds, which had a second party opinion certifying it's green. And there was 1 social bond in German consumer ABS, whereas the green bonds were RMBS deals. And one thing which was kind of new, at least to me, last quarter, is that there was 1 auto ABS deal, which was perceived to be a green auto ABS. In fact, the first green auto ABS, but it didn't have a second party opinion. So, and the transaction got the perception of being environmentally friendly or a green bond without the second party opinion because of transparency. So, or clarity around the collateral, which was all alternative fuel vehicles. And that stands out because it shows the second party opinion might not be really needed at all times if there's clarity around the data, which in our view circles back to the recent ask for more transparency from the European regulators and the central banks, on which we published a research report earlier this week, outlining what kind of data would be useful for investors, but also rating agencies, to assess the environmental credential in particular of securitization transactions. But long story short, we expect certainly that securitization has its place in the sustainable bond environment. And actually one of the asset classes because we can target certain collateral to be securitized, which is a prime candidate for social and in particular green bonds. So we expect that sub-segment of the market to grow. Okay, so with that, Mudasar, back to you.
Thank you, Christian. And now we look at onto the macroeconomic trends and how they may impact the European securitization market and what they kind of show us. So here are the 2 charts. One is on unemployment in Europe across different countries, and the other one is the inflation chart. It's a combination of money printing with higher energy and food prices have become a fuel for rising inflation, as shown in the chart on the right-hand side. Debate now is less about the type of inflation, but more about the consequence of rising interest rates or whether central banks can control the rising inflation. The question is when and where exactly this rising interest rate cycle will stop. The outlook for inflation and consequently the interest rates remains mixed. So most economists forecast a reduction in interest rates in 2024 and of subsequently the inflation too. Unemployment forecasts have also improved in most countries, reflecting strong labor market conditions. Household and corporate balance sheets remain strong in most advanced economies, in spite of recent market volatility and declines in the equity markets. So for further information on this, our commentary on the baseline macroeconomic scenarios and other commentary from our sovereigns team can be found on dbrsmorningstar.com. So the unemployment rate remains low, as seen on the previous slide, and then despite subpar growth backdrop, and the real wage growth remains contained overall in the euro area. Both euro area and UK economies face the risk of recession, and mainly because of the real income hit from surging energy bill and rising interest rates. Still, the severity of the recession is an unknown, although small rise in unemployment is likely. In leading European economies, the pace of deterioration is expected to be slow. And according to latest figures, the inflation is moderating, as we saw in the previous slide. This cooling off will relieve the pressure on central banks, which could result in more stable interest rate expectations. And on house prices, most of European economies saw rising house prices during and after the pandemic. House prices tend to drift upwards in an inflationary environment. But given some markets are already at their peak, combine this with rising interest rates may result in house pricing cooling off. Inflation here in this context means the borrowers are having to spend more on day-to-day expenses. Mortgage rates have gone up, energy and food prices have also gone up, and therefore some borrowers are stretched on affordability, on average buying power with stagnant real wage. So if you were saving for a house, it will take longer now to get onto the property ladder. Europe is little behind UK but on the same path. Given house is the biggest purchase, or for most a life-changing decision, even if some prospective buyers are in a position to buy, they're likely to hold off committing in anticipation of lower house prices in the next 12 months. So overall, expectation is a fall in house prices across the Europe. And continuing with the house prices and mortgage lending theme, usually just before the house prices fall, number of housing transactions start to fall dramatically with a bit of lag. And this is because sellers are not willing to accept the lower bids, and it takes time to adjust those expectations, which then result in lower transaction volumes. Most of European markets are still showing lending growth, as it can be seen on the chart on the left-hand side, but we expect this to slow down in coming quarters. Global financial crisis is a good comparison point when talking about house prices. Compared to now versus then, house prices are higher in many countries, and therefore level of mortgage debt per borrower is also higher. The biggest factor compared to last time was the central banks had the room to lower interest rates to make mortgage payments more affordable for borrowers. And this time we are going in the opposite direction, where we have higher mortgage borrowing and interest rates are creeping up, which is not good news. Having said that, not all is negative. One of the positive factors is credit standards are much better, not only the case of lending to borrowers who may deserve the credit. Very few borrowers are non-conforming or fall into subprime segment of the market compared to last time. Other factor is unemployment, which, as we saw on the previous slide and the chart, which remains historic low in the European countries and remains a big supporting factor for the house prices. As mentioned before, buyers might be more reluctant to buy in next 12 months, but most countries there is no oversupply of the housing stock. And chronic shortage and low unemployment hopefully will not create a forced seller's market, and both of these factors support house prices. So taking these factors into consideration, DBS Morningstar expectation is more of a price correction in the coming months rather than a crash, which we saw in the most European countries in the global financial crisis. So Christian, with that, would you like to say a few words on how the recent turmoil in banking sector may have impacted the European securitization market?
Yeah, sure. Thank you very much. So, Yeah, in terms of the turmoil in the banking markets, so the Silicon Valley Bank, Signature, now the focus on First Republic, and obviously closer to home, the Credit Suisse story. I think the impact can be always usually seen as twofold. So firstly, the direct impact on the European securitization market was negligible. Also considering swift actions taken in the UK in relation to SVB. But also in terms of the European banks, there was next to none counterparty exposure. So that means it did not have any impact on any of our European structured finance ratings. In terms of the longer lasting repercussions, it might just add if the discussions continue or the turmoil would continue, there might be more macroeconomic uncertainty globally ahead. So that would just add to the topic of softening macroeconomic environment and potentially affecting the performance. But where the turmoil had the biggest direct impact was obviously the issuance. And considering that, the start of this year, in terms of distributed securitization issuance in Europe, the start looks pretty much like 2022, where after a relatively weak end of the year, the year before, the year started with a recovery. And you can see that in the chart by number of transactions issued per week. 2022 and 23 did not look too different in the first 10 weeks of the year. And then in both years, something happened. And that was last year, the Russian invasion into Ukraine. And this year, SVB collapse and Credit Suisse takeover, which resulted in a lot of uncertainty, a lot of volatility, and an issuance stop. But what happened this year is that given the swift action and the low exposure in Europe, issuance has actually come back in a reasonable amount of time. We've seen it already, especially after the Easter period, with a lot of deals announced. So that's very, very positive. And now the question is, what do we think what's happening for the remainder of the year? And I think last year, what happened after the Russian invasion was the inflation picking up quite substantially, central banks starting their aggressive tightening path, subduing the issuance across the entire year. This year we are in a little bit different situation. So absent any additional shock, we would expect, as mentioned a few times already during the webinar, that we are now coming hopefully out of the tightening cycle with more certainty. So that we expect that the remainder of the year, like just drawing this chart throughout the year, we expect there to be a more pronounced recovery than 2022, with the red line ending up on average above the blue line, which represents 2022. So Mudasar, back to you. Last time.
Thank you, Christian. So just before we summarize this webinar, feel free to ask us questions by typing into your BrightTalk portal. So to summarize, all aspects of the economy, including both consumers and businesses, are facing substantial pressures due to higher costs from inflation. This does not spell a good news for some parts of the securitization market. Mainly the SMEs, the unsecured lending sectors, the NPLs, and some floating rate housing markets, includes UK in this case. We expect arrears to increase, but we also emphasize they are starting from a very low base. On the asset side, defaults remain low and are expected to remain low. And on the liability side of the securitization, there remains a sufficient credit enhancement and other structural mechanisms to absorb any moderate increase in defaults. Now, we also expect Europe to lead the shift towards sustainable capital markets with more ESG-related transactions coming to market. As Christian mentioned, we have seen 3 transactions year to date, which were issued with a second-party opinion. And this already is higher than the entire 2022 in terms of the number of transactions. As Christian also alluded to the fact that we forecast total issuance of 185 to 195 billion for 2023, with distributed issuance of roughly 48% of the total. And the reason we envisage higher distributed issuance is because of central bank's monetary policy tightening and reduction or complete stop of asset-backed securities purchase program. So I think with this, we conclude the webinar, and we thank you for the audience for dialing in and listening. And the presentation materials will be circulated after the webinar. And I hope that you found this session useful, and I thank you, Christian, for taking the time to participate in this webinar. Thank you.